everyone. It's Callie Arevalo, editor of Institutional Investing in Infrastructure. Today, joining me is Thomas Bayerl, Global Head of the Liquid Assets at MEAG, to talk about the outlook for the European transport sector. So, we're going to touch on a lot here. Thomas, just thank you so much for joining me. Would you like to give some additional color as to what you do at MEAG and just share a little bit of background about yourself?
Sure, Kali. Thanks for being here for the invitation. I'm global head of illiquid assets at MEAG, part of the MEAG board of management since many, many years. And with the role I'm performing at MEAG, I'm responsible for the investments in different any kind of infrastructure topics, including transportation and energy and so on, but also natural capital and private equity. And within the infrastructure part, debt and equity, we are actively investing in transportation topics. So we have, and we are doing also right now at the moment. As you know, of course, this sector is next to energy, very important topic to grow and to modernize also the infrastructure in Europe. Whereas it's a important topic for on the entire world. So also we see stuff in the US, also in South America, but main topic here is Europe, and this is also where I would say, play the most active part.
So you said the European transport sector offers attractive risk-return profiles for institutional debt investors, particularly in the decarbonization drive. Can you sort of elaborate on that and maybe touch on some of the opportunities that you're seeing there?
Yeah, so I would say the biggest opportunity, which is still in this sector, what we see and what we have also done in the past on many transactions, are the modernization or electrification of suburban trains. So in Germany, we call this S-Bahn, but actually the translation would be suburban trains. So that's so not the long distance, but the short to medium distance trains, also which help to commute people or bring people into the city where they work. And these trains go quite far outside the city centers and are capable for transporting a lot of people during the day into the city and also outside. So that's very important particularly for decarbonization, as the more trains we have and the bigger the capacity is on these trains, the more, of course, people they can transport, and the less people have the need to go by car to work. So I think this is one of the biggest attractive investments, where you have also I would say, a strong impact on decarbonization. In particular, as these trains getting decarbonized, so purely based on electrification. So this also helps additionally to reduce emissions of this train fleet. And what we see in these transactions also, well, apart from that you do something good, as I would say it, on a plain basis, for decarbonization and electrification. Also, we see attractive returns in this kind of debt transactions. Of course, there's an element of residual value, but we feel quite comfortable in these transactions. Actually, and we see margins of way above of 200 basis points, which on a relative risk return basis are pretty attractive. And these transactions are this strong nature of transportation deals per se, that these deals and these transactions are pretty stable in a portfolio, as they're quite structured robustly.
Yeah, no, absolutely. So how do the different subsegments of transport, like shipping, public transit, aviation, and other ones, sort of differ in this regard?
Things like shipping is still following his own rules, I would say. Shipping is, at least transactions we have seen, is more based on residual values. So you need more rely on I would say you need more to rely on that the ship is still required in 5, 10, 15 years from now, and offers still enough capacity and is servicing the needs of the tollers, which I would say is a little bit more, well, there's a speculative element. Um, this is where I see trains much more ahead. Is you have on the trains, they have pretty much of detail and analysis available there. You could say, okay, the train is still operated in 20, 30, even 50 years from now, after construction. And you rely not on, let's say, on the need of any toller or of any market economic development. So on trains, you rely on, okay, are there enough people in this area which utilizing the train, so to say? Which means, is it okay? Is it the need given by the population? Which means that the procuring authority, which is usually by the trains, is federal, states, or local authorities, that they still renew the concession in a 7 or 10 year tenor, actually, yeah, or stage. I would say this is where I see trains much more, but this kind of investments much more resilient and less volatile and less speculative than in the shipping area. And it's also within, let's say, of the lifespan of or where you usually see in ships, that someone is willing to lease the ship maybe for 10 years. It's difficult to amortize within 10 years your complete debt down to zero. So that's quite difficult, as you have to rely that you do it in the first 10 years, as the renewal of a contract is less likely or more risky, more speculative, as mentioned on the trains. And if we say, okay, the next bigger element would be in transportation would be roads. Also there, I would say different topic, as it is easier to estimate if, even if it is a traffic-based road in terms of the paying scheme, it's easier to assume and make analysis, in particular stress test, what might be the frequency the road is used, between, let's say, between capitals, from between countries. So it's much easier to estimate. And then you have the lowest risk version in roads, which is then availability based. So where you rely only on so to say, on the willingness or on the ability of a federal state to honor the debt service, or to pay the availability payment to the operator of the road. So this is where you could characterize. Yes, a ship I would see the most, or the more riskier stuff, less predictable. And then I would say trains, roads, toll roads, availability roads is so the other spectrum. This is also where we are actively in investing. I'd say less ships. And if we would do in ships, then we would look for a longer tolling agreement, but we wouldn't do it on, let's say, on pure container or any other kind of stuff. So if then we would do it, what we have done is on more specialized ships, where you have at least a tolling agreement of 15 years plus, which gives you much more comfort in terms of the debt service. So a long answer. I hope.
No, thank you. Obviously, there's so much to consider there, and lots of subsectors. So I appreciate you touching on multiple of them. So, you're at a very good spot in that you see a lot here, and you have a lot of experience to speak on it. So thank you. We talked about some of the opportunities, but I'm just curious as well about some of the risks. What are some of those big risks or bottlenecks you're seeing that could potentially impact or slow investment into European transport infrastructure, sort of as a whole?
Mhm. I would say. which sounds pretty easy. So the biggest risk is this that no people are requiring the transportation system anymore. So the less people are in Europe we have, or the less people in Europe are living, the lower the need, of course, of transportation. So I think so that we can something we can cross out. Okay, this is pretty stable, I would say, for the next decades. Um, so what else? The risks? Well, in terms of well, let's say bad behavior of the federal states, which might cancel, let's say, concession agreements. So this kind of not fair behavior by the procuring authorities. But so far in this sector, so we haven't seen this. I think there you have a higher risk in energy, to be honest, compared to transportation, at least given the history, what we have seen. Also, there I would say, okay, check, that's fine. And then it comes down to, well, if you paid by utilization, then of course, if you paid by utilization, like the traffic or the customers which are utilizing the facility, then of course it could be that with a new level of any pandemic happenings, that you have no one using the train or the road, as we have seen during Corona, for example. There we had, of course, a low or less on non-utilization, but still this period has been managed without any defaults in this sector. But if something like this comes up again and might stay longer, then of course this will have some more negative influence. So at the end, if it is utilization based, then yeah, if something like a pandemic comes, or let's assume that some countries might say, okay, we want at least that people are staying 4 days a week in home office and just come 1 day to office. Also, such things, of course, are changing the utilization. But this is what I see as really as a lower risk, which might come up. And with all the other stuff, availability based, there at the end, may what come, well, you get paid. Yeah. So even if would be no utilization. Yeah. So it's pretty, I would say, in terms of risks, you have, okay, if you have a construction involved and so on, then of course you need to take care, is the construction company capable enough to build the road, to build the train line, or are the construction companies for the trains, or this company is capable enough constructing the trains according what you have specified and according what you have specified in the time frame next to the technical aspects. Yeah. So these are more the risks, I would say, if it comes to in this sector. To if you construct something, I see the risk lower in the operational phase.
Sure. Yeah, that makes sense. Well, thank you for touching on that as well. It seems like a pretty solid sort of segment to be in. Were there any closing thoughts, any kind of final words you wanted to leave off with before we break?
Yeah, I would agree that it's a very, very solid asset class. So infrastructure per se, in particular transportation sector, I would say is the less volatile compared to other sectors. But everything depends on how you structure it. If you structure it loose, then and if you put too much leverage on the transaction, then of course, then by a sudden you have more volatility in such a deal, but not good. So far, investors, sponsors have not gone crazy.
No,
So
that's
at the
an
end, I
important.
would say it's a good, it's something which makes really sense to add it in a bigger kind of way, in a bigger portion, percentage-wise in the portfolio.
Perfect. Yeah, I think that's an important nuance to add. So thank you very much. I really appreciate you coming on and sharing your unique perspective on the topic today. So again, thank you
My
so much for
pleasure.
your time.